Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? It's Phil Tarrant here. I'm the host of the Smart Property Investment Show. I hope you're well. Tuning in live for those who are dialed into YouTube and other places. If you're watching us on the video, welcome. Thanks for joining us on another instalment of the Smart Property Investment Show. It's where we get together a couple of times a week to talk all things through property. Recording this on a Tuesday. Everyone's sitting around waiting to see what happens. I don't want to timestamp this, but, to be fair, you probably any time over the next 3 months, I might be right. There may be another interest rate announcement today on the positive side, but won't get too much into that today. It's a discussion for another time, but no doubt everyone's dialed in with the machinations of the market as it sits right now and how best you as a property investor can go about creating wealth through property. And that's what we do. A lot of people say they love property, but really, people love making money through property, and that's pretty much the way it is. And fortunate that there's many different ways and means Australians can do that. We talk about it on the Smart Property Investment Show all the time. One area we don't probably touch on too much is investing inside of your self-managed super fund. I do that. I sort of get a bit stuck into what I'm doing in my portfolio, and it's only just really the end of the financial year, so I went through the process of topping up my super to the maximum so I can continue to invest inside of super, which has its benefits and also its negatives. We'll probably touch on some of that stuff today, but I'm still very much on my own journey learning about how best to invest in property via a self-managed super fund. And it changes all the time, and there's always new stuff going on, and investing in residential or commercial property, but resi property inside of your super fund sometimes falls out of favour with the lenders. It's hard to get dough, or they start racking up rates so high that it becomes counterproductive in terms of the returns you get. A lot of leverage inside of SMSFs at the moment. You can't do a lot with your property if it's in there. Repairs and maintenance, yes. So we're talking about all this stuff beforehand. But as I've sort of continued this sort of understanding and appreciation of how you go about investing effectively in self-managed super fund, I learn something new every day, and I'm going to take you on a journey today as I learn something new, because I must admit I'm pretty light on some of the components we're going to chat about today. So I'm going to be pretty curious on this, as you can learn as I learn, and that's how I go about expanding my knowledge and awareness of different things going on. And it's a bit complicated investing inside your self-managed super fund. It's not only the lending itself, but, often the only type of assets you can buy in your self-managed super fund is established properties, whether it's commercial or residential. But there's some stuff happening in the background. There's some smart people who are sort of poking the status quo and trying to change the way it can be done. And I know most people who are investing inside of property, inside of their self-managed super fund, is looking for eventually good yield to provide for a comfortable retirement, on the basis that when you do decide to go 6 feet under, there's an asset there that may have continuity through family that can continue to deliver value, or can be sold down and realised to provide a nice asset for someone who remains. We'll get into this all today. Joining me in the studio, Raymond Hempstead. He's the managing director and the founder of One Contract Property. I'm not going to hold it against him. This guy is an accountant by trade. But I like accountants, all right. Raymond, how you going, mate?
Feel pretty good.
So you obviously like self-managed super fund investing for residential.
I do,
yeah,
because it's had a bit of a past with my dad, because he didn't have one, but where he ended up. So it has a bit of a place in my heart, yeah.
And to the point I made is, like, it feels like 10 years ago, everyone was talking about investing in self-managed super residential property, and there was some people around who probably weren't doing the right things. And I think some Aussies found themselves maybe investing in super when they shouldn't have been investing in super, or they were complicated, or the construct of it made their position too complicated. And they sort of fell out of favour when the banks ratchet up all the rates, and everyone's going, why am I paying 3% over what I can outside of super? But super seems to be falling back in favour for residential and also commercial property investment as a huge asset class. A lot of people don't understand it. It's bigger than retail and industry funds, isn't it?
Huge, absolutely. And it's changing, and it's growing in every day. Like, I think there's 600 more super funds being set up every week.
Is it that many? How many
super
super funds? Like, last time I really looked, it was about 1.1. No, it's about 1.1 million trustees or something or other.
Oh, there's 1.1 million as in individual members.
Yeah.
There's just under 700,000 self-managed super funds set up across Australia.
700,000 self-managed super funds. That's a lot, right?
That's a lot. There's a lot of people actually taking control of their super.
Yeah, and now assets undervalue inside a self-managed super fund. So the point is bigger than what sits inside a retail and industry funds. And when you look at the list of asset classes, like resi property is the top, self-managed super, it's bigger than the equities market.
Yeah.
People don't know. It sort of goes under the radar.
Yeah.
They think
Aussies love property.
they love it.
Yeah.
They love it. And they think investing in your SMSF is only really for the wealthy, but 700,000 people, 700,000 funds, 1 point something million trustees. The trustees is the people connected with it. Goes to show it keeps growing.
It does.
You're doing the right gig then, self-managed super.
We're certainly out there to change the market and change people's perception and give them back choice. Yeah. And you were saying about 10 years ago, it did come into favour, and it was a lot of that was around the marketers, I believe, that were actually, there was a little bit of choice, but there wasn't total choice. Yeah. And that's where people got themselves into trouble.
And I think some of those people actually got themselves into trouble, and they were either, I can't remember particularly names, but they were either chased out of Australia or they ended up in the big house for doing inappropriate things. So,
yes.
And a lot of people sort of got a bit burned, but
yeah,
I think, and to your point around your father, the idea of creating wealth in a self-managed super fund is to take control of your financial future for a more comfortable retirement. So that's what most people want.
Absolutely.
The fact that a lot of people don't find it and they end up on a government pension or otherwise, but the fact that people are tuning into this means they're invested.
But that's not just self-managed super funds. That's
everything.
That's industry super funds as well. Like even the government talks about a comfortable retirement in super is like just under $700,000 in your super, and that's like $1,300 a week. But that's including part of the government pension.
Yeah,
and that's what they call comfortable retirement. So
I don't think it is today, the cost of living and all that sort of stuff. So, but the point being that if you're tuning into this, it means you're at least part way down the pathway of trying to take control of your financial future. And the fact that you're invested in that means that you're probably well ahead of most Australians. So you can invest inside of super, outside of super. We normally talk about investing outside of super, but we do touch on investing inside of the self-managed super fund. And for a lot of people, I guess they might have a financial advisor. It's not often a financial advisor will actually say, hey, have you thought about property, right? And this is it. If you don't open your bandwidth or your breadth of connection around the type of things available to you, you can end up doing the wrong thing and just pumping all your money into retail and industry funds.
Yeah, but up until now, a lot of the financial planners, even if they have been property focused, there hasn't been a lot of good investments to be able to direct clients into, so they have put them back into the industry or back into the share market on that side. So
yeah. Anyway, well, hopefully you guys are out solving it. So let's have a chat about your business, and I always say it makes sense to call your business pretty much what it does, and yours is one contract property. So there's a clue in that somewhere, and this is like to my point earlier around my sort of constant education around all things investing in and out of super funds, but for today it's investing inside a super fund. Traditionally, you can only buy established properties inside of your super. You can't.
That's right.
You can't buy land and then build to create an asset, which is a cash flow producing asset.
Not if you're going to use debt.
Not if you're going to use debt. So you can do it if you got cashed up.
Cash?
No worries. So if you're using leverage, which a lot of people, when they're buying probably the first few assets inside of super, are probably using leverage. So I didn't realise that. I didn't know that.
Yeah. It's part of the ATO legislation, and it's there for a good reason, because if you're buying a block of land and then buying a house and you're building a house, until the house is completed, you actually haven't got an asset. You've just got tens of thousands of pieces. So if anything happens to the builder on the way through, then there's that asset in the super fund is actually not there. So therefore, it's taking away from the security for the long-term benefit of the members of the fund. So that's a good protection that the ATO has actually put in place.
And it makes sense.
Yeah, absolutely.
So up until this point, you couldn't say, all right, I've got 300 grand in my super, I'll buy a block of land and I'll fund it, and then I'll build a house and I'll fund it so I get an asset. So that's not non-compliant. You just can't do that.
Yeah.
Yeah. Okay. I just didn't.
Yeah, no.
I probably, to
Totally
be fair,
legal.
I've never really looked at it, but I just assumed you could. So it's actually legal.
Yeah, it's actually legal. Yeah.
So what you guys then has created a way in which makes it legal. So I don't want to get too much on the legalities of it, but maybe the best way to approach this then is, why would you buy a block of land and build an asset on it inside of your super versus just buying something established? Like, is the juice worth the squeeze? And I think that's probably where we should start with it.
If you're buying the right property, yeah. Like in the past, and before we spoke about, there's been people that have sold off the plan properties and they mark them up fairly heavily. And so is it worth it? Sometimes yes and sometimes no. But I suppose when you look at across Australia and you've got the choice across Australia and you can choose and you can negotiate with the builder and you can come up with a price with the builder and the land, and you can package that inside your super and make a positive return on it, then yes, it is a good investment in my opinion. Like, I'm not giving financial advice.
No, and either am I in any means. And there's a nice way for us to have a nice disclaimer. This is just a couple of guys talking generally around property. There's nothing constitutes financial advice here, but we'll talk about some of the theories or the practical applications of this, and I think that's more than fair and appropriate. So the position is that property investors investing inside of the super fund, they're chasing two things, right? They're chasing capital growth and they're chasing yield. And you often find inside a super, a lot of it is the cash it puts in your back pocket every week or every month to provide you retirement living. Whereas investing outside of super, a lot of people might be more focused, and this is really general on capital growth. But you want both, but in super, there's a lot more alignment towards cash flow, right? What's it paying me every day?
I think it should be focused on both because it is a long-term asset. But I suppose just a quick one, putting it in your back pocket actually doesn't go in your back pocket. It goes in the back pocket of the super fund
that pays you out.
That pays you out at the back end.
Yeah.
Yeah.
And so the logic being that a new property that you build and rent out can potentially have greater cash flow earning capacity. And that's your point.
Yeah. Like, even if you just look at like, we do a scenario, if you're buying a high cash flow property, when we talk about NDIS or co-living quite a bit, if you're buying that outside of super and it's $1 million property and it's making you $2,000 a week gross in rent, if you're holding that at 40 years old and you hold it for 26 years, 20-year debt against it, you're going to end up, and it's in your personal name, you're going to end up paying roughly around $750,000 in tax. Now, if you hold that in a company, you're paying about $400,000 in tax. If you hold that in a self-managed super fund, you're paying a bit over $200,000 a year in tax. So just in the tax saving and the tax treatments in each of the different vehicles you hold it in, you actually end up with more cash in your hand just on that basis inside a super fund.
And that's the accountant talking there.
Exactly. The last point I put there is, if you're holding that same asset in your own personal name or in a company or trust, even when you hit 65 or 67 and you retire, you're still paying tax every day after that. Whereas if it's in a super fund, once you retire, in most situations, you'll actually pay zero tax and also zero capital gains if you sell it at the back in retirement.
Yeah, and which is attractive, right?
Yeah.
And it's the reason why there's 700,000 super funds these days.
Absolutely.
People and a lot of people invest inside of their super as a result of probably some recommendation from an accountant or a financial planner. And it could be one or the other. But good accountants, property-orientated accountants are well aware of this.
Yeah.
And a lot of people are cynical about that. Go, well, accountants will just get you set up a self-managed super fund because they make fees out of it and there's ongoing compliance around it. Like, that's a cost of doing business,
It
right?
is.
So don't dwell on that. It's about what are the outcomes of that. And what you spoke about there is the practicality. The upside practicality of investing inside of your super fund around taxation.
But also, let's go back one step. Yes, there's fees and charges that the accountant will charge to actually manage that for you during the year. Have people actually stopped and looked at the fees and charges they're getting charged by the industry super funds on their money week in, week out? And I think the numbers are, if you've got more than $150,000 in your industry super fund, you're actually spending more money in most cases in fees and charges than it would to actually manage a self-managed super fund. So it's like swings and roundabouts.
Yeah, you won't hear that in many places because the industry and the industry and the retail funds have pretty good lobbying arms to make sure. And you see it happening now, right? They're the crew who's been. It's not beat up on these people, by the way, but they're the crew who've been really lobbying government to try and put caps on self-managed super funds, right? Because
that's right.
They want people make their retirement savings inside of retail and industry funds. Like, that's fine, and that most Australians that suits, right? You know?
Like, I'm not against that. What we're doing at One Contract Property is basically giving people choice. Like up until now, they really haven't had choice that they could take their money out of an industry super fund and put it in high yield cash flow properties because you've got to build those. Up until now, they haven't had. Now they've got that choice, and we're just trying to get the word out of the market. Talk to your advisors because you do have that choice now.
Yeah, and you know, and if you're sitting here going, "Oh, this is pretty interesting," you can call these guys and find out more. But I also recommend chat to your accountant to start thinking about it. If you're not yet at a point to set up a self-managed super fund, start thinking about it. It's not financial advice by any means, but be aware of it. But let's get back to this one contract property. So this is this construct that you've created, pioneering, which allows people inside of their self-managed super fund to leverage the process of buying a block of land and building a house on it. Might be right for you, might not be right for you, but I want to get into that. It says it on the tin, one contract property.
Yep.
So traditionally, if you wanted to buy a block of land and then you wanted to build a house on it, you normally have two contracts.
That's
and
right.
probably two bits of debt connected with it, right? So you've worked out a way to glue it
Put that
together.
together.
Okay, tell me about it. How does it work?
All right.
And let's just remember that most people probably are like me and not the smartest person around. So
All right.
simplify it for me. If you simplify it for me, it'll probably work for most people.
It's about giving choice. So if you walk into a home, one of the display homes around Sydney, probably not Sydney, these figures I'm talking, but say you're buying a block of land for 300 and you're building a house on it for another 300. You walk out, think, great, thanks very much. I've spent $600,000 on a house and it's going to get built. Now, what the salespeople won't tell you is the additional costs that are going to add to that. Now, depending on how long it takes to build and all the rest, you've got another probably $50,000 worth of costs on that before you get a set of keys in your hand. And you can actually walk in yourself or you can walk your tenants in. All right, so we recognise, okay, that house, that brand new house is going to cost $650,000. You're funding that with the bank. Now, to turn it into a single part contract so a self-managed super fund can get it, and it has to be a single part contract, someone's got to fund that process. And up until now, if you could find it, that's the builder. The builder's actually coming up with the money and he's funding it. And at the back end, you pay the $650,000 or maybe a bit more to the builder. Now, builders aren't in a position of financing those debts. What we've done, we've said, okay, if you've got a 35% deposit in your super fund, you can now get into that process. Simply to work through that, I suppose, work through the legal side of it. You choose the property, you choose the builder, you do all negotiations. One contract property, we then actually buy the block of land. We settle on the block of land and we enter the build contract and the land contract. So from the builder side, it stays a two-part contract. The builders love it because we pay them all their build progress payments. We're not going in and negotiating. You do all that. We pay them all their build progress payments. And then we add on, we charge $10,000 plus GST for our fee. And then we add on our holding costs that we've got, our interest, our QS fees, our legal fees, the land tax that we've got to pay because we hold so much land around the country. And so that $650,000 property will turn out to be about a $690,000 single part contract where you'll pay a 35% deposit up front. The house gets built, the builder gets paid, he gets settled, he gets OC, and at that stage, you then have a brand new house and you come up with the 65% funding from a Tier 2 lender inside your super fund, and the title gets transferred into your super fund at that stage.
Okay. Pretty simple.
Yeah.
Pretty simple. So I sit there, go, okay, the way on wire is go, where does the risk sit with this, right? And I go, well, builders go and bust all over the joint.
Yeah.
But what you're saying is that the builders get paid from you, the funder.
Yeah.
Okay.
And there's also home warranty insurance across the build as well.
Yeah, okay. So you tick that box. So it all comes down. So essentially, one contract property owns the project to a point where it gets OC being the occupancy certificate.
Yep.
And that's when, so it's like you're co-investing with the super fund because they got 35%, you got 65% in. And at that point in time, you go, okay, here you go. Here's your finished product. You can walk in today and live in it.
Inside a super fund, they can't live in it.
So you walk in there today and put an investor in it.
Yep.
But that's when you go to a bank, Liberty or whoever does super
Yeah,
fund lending,
Latrobe.
say Latrobe, all those guys, and
Columbus.
say Columbus.
Yeah, Granite Origin.
Yeah. So you guys fund the process, and then you got to go to a lender to find that 65, then you get paid.
Yeah, exactly.
Okay. How many of these have you done?
Just under
There it is.
300.
Okay, so it works.
Yeah, once or twice.
Yeah.
People are very happy. Even some of our staff have actually invested in it. We've just got a new BDM started on Monday, and she actually bought one about 18 months ago.
Okay,
And now
she went, I like it. And you're talking about 600 grand examples. That's probably not Sydney. It's probably going to be more like Brizzy or WA or there's no geographic limitations for you guys? No.
Australia.
Like
The choice is, I suppose, the way I like to promote it, however you can invest outside of super, you can now take that same model and invest inside super. So we've got guys that have bought a block of land, and we're doing the subdivision on the land, and the super fund's owning 5 blocks of land on a subdivision that we've put together on their behalf, and the super fund's actually picked up the profit. So that's an extreme. We've got people that are buying NDIS properties or co-living properties, but they're choosing it. They're looking around Australia where their advisors and them think are the best idea. They're choosing the builder. They're choosing the style. They're coming up with it, and we're just the intermediary that puts it all together for them.
Yeah. So you sit in the central sort of hub, sort of pulling all the levers in the different parts of it. So who manages the build to make sure the build is getting done properly on time? Is that still the super fund trustee? Like you guys you're funding them with the part payments around it, but so who makes sure it doesn't go wrong?
That's our internal staff.
Okay, so
we manage all that process.
So it's like, I hate to use the term, but it's a turnkey thing. So like, if you're the trustee of a self-managed super fund, you don't need to get your hands dirty.
You can be involved as much as you like. You'll get reports at every stage of where it's up to, so you can see it going. Like most builders won't like, even outside of super, don't like the investors actually get on it to site.
Yeah.
But you do get all the regular reports just as if you're investing outside of super.
And so the super fund trustee, it's using the technical terms, the person that part of the super fund, they choose the builder.
Yeah.
So do you have integrity metrics about the type of builders that you're happy to sort of go down this pathway with? Do you need to sort of due diligence the builder and say, I'm going to pay this bloke, he's going to blow it all at the pokies or somewhere or other? Or how's that work?
I'll
yes
go
no?
through. Is it a no? It's the client's choice. Out of all the contracts, because I personally sign every single contract, so I've got to be comfortable with the contract that I'm signing.
Yeah.
And we then mirror the terms and conditions of that into the single part contract that the self-managed super fund signs.
Yeah.
So the self-managed super fund gets their own legal advice, their own direction. And as I said, we're the intermediary. Unless there's something really glaring in the contracts, I'll take what they've done because it's their investment, their money, and I'll sign off on that and put it through.
Because you're absorbing some of the risk through this process, right? Because
Yeah.
you've got to fund the build, essentially.
Yep.
It's good that the builder gets paid. Typically when builders get paid, if you're making progress payments for builders, they're normally pretty happy. Yours is typically the project that gets prioritised. I'll give you a hot tip. But one of the challenges is when people go down this pathway outside of super, if they just using a major bank for development or non-majors or otherwise second-tier banks. One of the biggest issues is trying to get the money out of the lender to actually pay the builder.
Absolutely.
And they sometimes make you jump through hoops. But so you guys police and control that process.
We control that process. We manage that between the builder and our lender, and we then ensure that the builder's paid in a timely fashion on the way through. So we have QSs and inspectors go out at every single stage. And I think we've only had, out of the hundreds of deals that we've done, I think we've only had 2 builds where we received a slab invoice, and when the QS went out to site, the grass was about to go high.
These things sometimes happen. So you guys fund. So you the self-managed super fund enters in a contract with your business. You essentially fund the build. With this I guess a arrangement that the super fund will take over it at the point in time when it comes to. I get all that. That's cool.
Yep.
How do you fund your contribution to this? So you use Columbus Capital, is it? So
yeah.
Okay.
So we have we've got some of our own money involved in it as well. I've had to have skin in the game.
That's the way it is.
The lenders won't lend it otherwise.
No.
But we then, the 35% gets actually released to us on land contracts.
Okay.
That gets used against the land. The super fund then gets a caveatable interest against that block of land. So the super fund's money go in, our money goes in the land. They get a caveatable interest against that after Columbus Capital has put a first mortgage for the construction finance against that.
Okay.
And then we fund the process
All the way through.
on the way through.
And then at that point in time when there's a set of keys that can be given to an investor and the property goes into the title of the self-managed super fund,
Yep.
The self-managed super fund can use Columbus Capital as well to finance the whole thing if they want.
Yeah. It'll either go through, at the back end, it's their choice.
They use anyone they want, but they can also use Columbus.
Yeah, Columbus Capital, they've got a retail arm called Homestar.
Okay.
So the individuals can go to them and deal with them directly.
Okay.
Or if they've got a broker, they can go through Origin or Granite and deal with the brokers through that way.
Yeah, okay. Okay, that's good. I get it. It's pretty simple.
Yeah.
You know,
And
there's some terms there that some people would be going, I'm not sure about that. Go and speak to your accountant around it. But is the ATO happy with this?
yeah, like when we actually came up with the concept 3 odd years ago, we actually approached the ATO and they said, I applied for a private product ruling on the process.
What's a private product ruling?
So that's where I've interpreted the law one way and I've asked the ATO to actually come back and confirm my understanding of the law and that we're following it. And they actually came back and said, no, we can't give you that because we've already given a public product ruling that covers exactly what we do. So the process that we've come up with is actually clearly defined in the ATO public product ruling.
Okay, so they're already given a public product ruling on it. When you thought, I think I found this, and they've gone, no, I've already thought about this. That's all cool. Go ahead.
Yeah, exactly.
Okay, so they're happy with it. So it's compliant.
Yeah,
which is the big thing about super fund lending. So this, I said I didn't want to get too much in the legality of it, but and your accountant can help you with this if you need sort of second opinion on it. But that's there. It's there. It's available. You can go and have a look at it. It's codified inside of ASIC ruling, being a public ruling on this thing. Okay, so I don't want to use the term getting around the way it is, but it fits well within the contract with the ATO, so you're not going to have problems moving forward.
Very much. Yeah.
You said you've done 300 plus of these, I guess, deals, if you want to call them that. Like, has it gone wrong, or where can it go wrong?
Where can it go wrong? People ask what happens if one contract property disappears.
Yeah.
That's an obvious first start. If you look at the whole structure that we've set up, there's a 35% deposit plus our money goes against the block of land. We pay the builder the 5% build deposit in cash, and then there's construction finance at the back end, which covers the 65%. Now, if anything happens to one contract property, the bank has already got a first mortgage against the property. For them to get their money, they've got to sell the property. Usually they'll go out to a fire sale. But going into the deal, we've actually already given them the sales contract of 65%. So they're guaranteed of getting their money at the back end. So they continue to pay the builder, even if we're not around anymore. And they've already guaranteed getting their money at the back end plus the money that we've got in the deal. So even if we're not there, because of that structure of the financing, that's already securing the self-managed super fund.
So the self-managed super fund that puts in 35% has some assurance the fact that the lender is also invested in the outcome of this, and therefore they will see it to conclusion. And the 35% that goes into it, there's still the ability for the self-managed super fund to. Okay.
And they've got a caveatable interest over the block of land as well.
So can you explain a caveatable interest?
All right. A caveatable interest, it's a document over the title of the land declaring that there's an interest by a third party in that block of land, and it stops anybody doing any financial transaction against that block of land until that I suppose, lock is removed.
Yeah, it's lifted.
It's lifted out, yeah.
And you see it a lot in, and I've seen it in properties that I've bought, which have been developed, and I've actually picked up some properties like at 95% completed, right? And to do the finance around it, when you actually look at where the money goes, you normally find it at a development level. There's normally lenders all over the joint, right?
Yeah,
There's absolutely, and they've all got caveats on the actual release of the property needs to be
protecting
left
their
to do it.
interests.
Like so this is all normal, but the point being is that a lot of people be sitting here maybe feeling a bit bewildered by all of this stuff, right?
Yeah.
And you know, being bewildered is okay because it probably makes you a bit curious, and being curious means you go out there and find more information. So I'd be absolutely chatting with these guys at One Contract Property. If you need more information around, or go and speak to your accountant or any of these terms, you go and check it out online. But so the point being, why would you go down this pathway? And you said you just got a new BDM that liked it so much they now work for the business. Like, why would you go down this pathway versus just buying an established 1980s built property in Western Australia and put in your super fund? So there's a little bit more risk, but I imagine the upside is potentially better.
There is. Like, if you're buying an established property, that property's already had capital appreciation, which you, the investor, now buying and paying for, right? Yeah, the area around it might have gone up. What's the rental desirability factor? What's the repairs and maintenance factor? Is there any depreciation? And I suppose not to do it, but now you've actually got a choice where you haven't had before. So you can, if you're spending $800,000 on an established property, you can now build a brand new property for $800,000. Depending on where you're building and what you're building, you can actually determine what sort of rent that you're getting because of what you're building. So you've got more control over that side. You've got better depreciation, so you can claim a non-cash deduction on the way through. The repairs and maintenance for the first 5 or 6 years should be better than the established property. And if you look, even if they were side by side, if you're a renter and you could buy you could live in an old property or a brand new property, which one do you think you'd be living in first? So it's now coming back to what's your preferences, where do you want to live, how do you want to invest? Now you can actually buy new and pick up the capital growth out of a property long term.
And that's the point. Now you can buy new inside of your self-managed super funds. You have to crystallise this whole conversation. That's probably the crux of it, right? Now you can buy new in your self-managed super fund when previously under, well, you know, the previous contracted, or you can only buy existing. And you got to ask all the questions. So, but you're quite a way down the process of investing in property. You still need to find a location to invest in.
Yeah. Right.
And you still need to think about what type of property you need to have in that particular location. You don't do any of those recommendations, right? So
I think
everything remains the same. Like so do buyers agents know about this type of thing? Like
some of them do. They're getting to know about it. I think even before we talk about property, it comes back to why you're looking to do it.
Yeah.
It's like what's your dreams, what's your goals, what's your motivation of getting into property? Now, if it's short term and you're getting in and getting out, and like, maybe that's not the best thing for superannuation, because superannuation is for your long-term retirement. But it's like there's short and medium goals that people should have, and that's before retirement.
Yeah.
And then the long-term goals of how they're going to be supporting themselves after retirement. Now they've got the ability to be able to develop property inside the super fund that can meet those goals, and they can actually have a solid plan about, okay, they want to make $180,000, $200,000 in retirement each year. They can set up a portfolio that actually generates them that. Now, up until now, you really haven't had I'm going to say as close to guarantee as you can. I'm using that word very loosely. But you haven't been able to set down a real plan with a surety about where that's going to be. And in my opinion, I think property is the only way that you can set that down and come up with that end result.
You must be busy.
We are.
Like looking at every deal. But you obviously enjoy it, right?
Love it.
Yeah.
Love it. Yeah.
So why? Why do you love it so much? Is it the outcome? Obviously, you make it. I hope you make it a few bucks, because that it helps the integrity of One Contract property. But I think there's a bit more than that, right?
My dad was a worker. In his early 50s, he lost money in his super because he took some incorrect advice and got out of a share and went into a safe share at the bottom of the market and never recovered. And I lost Dad over the last couple of years, and in the last number of years of his life, it was hard seeing my dad worry about how he was going to look after his wife after he died, because he had Parkinson's and he knew he was dying. and he knew he didn't have enough in super. And so when I came up with this solution, it just resonated with me so hard that the population in Australia hasn't had the choice, and we haven't been able to take control of it in the maximum way. And I see this as a way that we can take control of our super, that now 11% of our wage is going in there every month, and do something that will actually give us a better outcome and not necessarily have to rely on the government income, a government pension at the back end, if we set up the right type of properties now. And then on the other side, I suppose we do quite a bit with NDIS and SDA providers in the NDIS space.
STA?
Special disability accommodation.
Yep.
So working with the disabled sector across Australia.
So these are different types of properties, right, which are, multi-room and all this sort of stuff?
These are very specific houses that are being developed for people with disabilities.
Okay.
And there's government funding that supports them getting into these right type of housing. Now, done correctly, they're a little bit more expensive, but there's some major cash flow out of them. And I'm being very specific, being done correctly with a client focus in mind. You can develop a house that can give long-term accommodation to disabled people and give them quality accommodation and quality life, but you as the investor can actually make some serious cash flow on the way through as well.
Yeah, some people might go, the government should be providing these properties anyway. I'll tell you what, the government probably underfunded around, don't start me on funding for disability and more welfare-orientated stuff, but it's okay if you can actually be a provider. And you got to remember, I think 94% of all investment properties are essentially owned by mum and dad investors, right?
That's right.
Investment property, rental
People
properties.
like you and me.
Yeah. The government provides some of it, and large institutions provide other parts of it. And that's sort of growing a little bit. But you've got to remember, mum and dads typically provide the housing for a third of all Australians. And some of them are renters. Some of them need more specific rental accommodation, talking about NDIS or those with disabilities. And if you can provide that stuff and that resonates with you, why not? And it's okay also to, if it's part of your wealth creation, your retirement plan. And the government, you need to remember, the government actually invests as part of its construct that mum and dad Australians provide this stuff. That the tax regime supports it. And to your point around investing in super, there is a ruling around this that allows it, right? So why not? But the why not is a question you probably need to have. You're an accountant. I'm a cynical journalist, right? So if you were sitting here and you're going, okay, all right, this all sounds good, I get it. What would you do next? How do you be comfortable about the decision to work with one contract property and why it's right? For what questions would you be asking yourself, or if you're on the other side?
First of all, you got to about what are your dreams, what are your goals, what are your aspirations? You've got to have those sorted out before you. If you're going to anybody and asking advice, if you haven't got that sorted out first, and you go to someone for advice, what are they going to tell you? They're going to make it up.
So you've got to take control of the outcome you want.
Yeah, so you need to take control. Where do you want to end up? And then if you haven't got the financial, you're not savvy in financial, seek out an accountant or financial planner that understands property. And I suppose they need to understand not only property but shares and insurances. They need to be able to talk to you about all of those equally, and then get advice from a financial planner, an expert on that side of it. So one contract property, we just provide a facility to be able to turn a two-part contract into a single-part contract. We don't necessarily give advice on that. So you need to be talking to professionals about that.
Yeah, and I think you need to, number one, you've got to be invested in the outcome and be responsible for the outcome. Yeah. You're not outsourcing this in any means. No. And then you need to build the team around you. And I would say if you're thinking about this as a pathway of investing in your self-managed super fund, a company like One Contract Property would be part of that team.
Absolutely.
And you're comfortable to work with accountants and
100%
and all that sort of stuff.
Even though I have been one. No.
And if you don't, he's going to hate me for doing this. If you don't have a good accountant that gets property, I'm happy to sort of send you. I don't really want to because I want him all for myself, but you'd be happy to help you out. Just contact the team at editor@smartproinvestment.com. If you don't have a good accountant, I'm happy to share details with a couple that I use. But that's cool. So what's next for you guys? If people want more info, can they call you?
They can call us. They can hop onto our website at onecontractproperty.com.au, have a look. There's a whole lot of information in there that will educate you about single part contracts and what it entails. And likewise, if you need some advice on who to speak to, we've got a range of people, accountants, financial planners and lawyers, etc., that we can direct you to that are third parties from us that play in the space.
And they work on behalf of the SMSF trustees. So, so you choose one that you think's right for you, and they operate in your best interest.
Exactly.
Okay. So how many of these can you do? Like how big is the funding pipeline for you guys? If everyone goes, that sounds really good, I want to have a crack at it. I imagine you can't do everything all at once, right?
Oh no, we
got capacity?
Yeah, we can do 200 a month at the moment.
You can do 200 a month.
Yeah.
Okay.
Yeah.
That's
we're pushing
quite a bit of
towards
capacity.
that.
Yeah. So
Yeah.
and the funders are happy with it. They obviously I guess they get a good earn on the way through. So
if you look at it, because every deal is self-securitized, so from them it's just growing their pool, and it's a very secure asset that they're actually investing in. So they're like Columbus Capital and the team are very happy in backing us in what we're doing.
Okay, so they know you're doing this today, going
100%.
Yeah, okay, all right. Well, there you go. Yeah, go and check it out. I'll dig around as well. I'm sort of the things I don't normally develop, probably because I just ain't got the time, energy, and effort and bandwidth for it. Right?
Yeah.
Other people, are better at doing it. But the point is, and I always come back to what is the simple thing that I've learned from this is that you can now have new residential property in your SMSF where previously it was hard to do.
But also new high cash flow properties.
That's the high cash flow thing.
That's the key. That's the kicker.
And you sort of make sure you buy in the right spot so you do get high cash flow.
Yeah, exactly.
So all the fundamentals remain the same. You still got to find a good location for a good reason why and match it with the right property. But a lot of benefits in, again, speak to your accountant, all those things that new property gives you that existing property doesn't. That's good. Well, Raymond, thanks for coming in. Have a yarn, mate. I've really enjoyed
Appreciate it, Phil.
Yeah,
Very
keep
good.
at it. It's good. I have to get you back in and having a yarn with you. I was interested to see how this goes.
Look forward to it.
Yeah, it'd be nice. What was your website again?
onecontractproperty.com.au.
Okay, right. And I'm sure you can find these guys. Just Google them. Go and check it out. That's Raymond Hempstead, founder and managing director of One Contract Property. Hope you enjoyed that, everyone. Remember to check out smartpropertyinvestment.com.au. If there's any terms there that sort of you're sitting there going scratching your head about, I'm sure you can probably find it on there. But again, send the team a note around anything if you need any sort of further queries about anything we spoke about. Happy to help you out. That's editor@smartpropertyinvestment.com.au. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.